this is not something that is normally part of your benefits and retirement scenario, right? It's not your FEGLI that we've discussed. It's not the retirement system. It's not TSP. It's not the first supplement. It's not the survivor benefits. This is something totally separate, but it factors in to retiring how you want, when you want, and the way you want, living the lifestyle that you want. We've talked about planning for retirement, saving more money, taking advantage of everything the government gives you, working enough time to get a pension that's going to be, high enough for you, or a large enough amount for you. But that all goes for nothing. That's all great work, but it's all going to be negated if you have a debt problem. And that means too much money is going out the door to service your debt, money that you've borrowed, loaned, charged, whatever it might be. If there's a debt problem, and I mean, everybody's debt situation is different, so the word problem is going to be different for everybody, but why not eliminate debt, get rid of it along the way? Now, in general, why do we talk about this topic? Because it factors into your retirement. And just general guidance, blanket statement here. It's not specific to anybody. Blanket statement is, we would like folks that we work with, federal employees that we talk to retire as close to debt-free, if not completely debt-free, as possible when you hit that retirement date. Usually, the only acceptable debt we'd want to have on the books may be the mortgage, right? But if you can get rid of that too, why not? And we'll discuss that here in a second. But the idea is, you plan for retirement, you save up money, you're building up your pension, you're deciding when you're going to take Social Security, et cetera, et cetera, et cetera. But we also have to have a plan to get rid of the money that's going out the door. It's going towards debt service. So what are we talking about today? Again, it's eliminating debt, getting rid of debt in a fraction of the time so that you can retire, again, how you want, when you want, the way you want. Question for you. Question. And it's going to sound like a sales pitch. It kind of is, but question. What if I could show you how to get completely out of debt, including your mortgage, in 10 years or less without spending any additional money than you're spending right now? Is that something you'd be interested in? Now, this is not debt consolidation. This is not, we're buying up debt. This is not messing with your credit or anything, but this is developing and designing a plan to hyper-focus on your debt, get rid of it in a fraction of the time, ideally without spending any additional money than you're spending right now. Is that something you'd be interested in? Chances are, and in the conversations I have with federal employees, I see head bobbing, chances are you would say yes. Well, why do we want to do this? Why eliminate debt? Number one, when debt's gone, you're eliminating payments to debt. Now, when you eliminate the payments, where does that money stay? It stays with you. It's not going to the lender, the creditor, the bank, whoever loaned you the money or whatever credit card you're paying off. You get rid of the payments, you improve your cash flow. Money is staying with you. That's more money that does not go somewhere else at the end of the month. Now, when we do that, if we get rid of the payments sooner rather than later, we are also eliminating or reducing the volume of interest we're going to pay. Now, some people would look at me and say, well, Val, you said including my mortgage rate is only 2.5%. Why would I pay that off at only 2.5%? It's a very good question. But do me a favor. Look at your mortgage payment that you have, the next one that you're making, and tell me how much of your payment is going to interest. How much of that payment is going to interest? If you have a 2.5% mortgage, I can almost guarantee, I don't want to say fully, but I can almost guarantee that it is a lot more than 2.5%. In some cases, it could be over 50% of that payment is going towards interest. So is it really only 2.5%? It's not like if you bought a $1 million house that you're going to end up, paying $1 million, 2,000. You're not going to be paying 2% on it. Look at the payments over time. Tell me how much you paid for that home. So we reduce the volume of interest, right? So it's not only free up the payments, eliminate the payments, free up cash flow, reduce the volume of interest. Now, what can we do with that money? We can redirect it and save more for retirement. So if you pay off debt sooner. Now, if it's a one debt or two debts or three debt or whatever, I'm going to go over an example here in a second and show you. But you can save more for retirement by redirecting those dollars towards your future. And then ultimately, if you retire debt-free, this is a worry that is off your plate. It's not an obligation that you have anymore. It's not something you're going to leave for your loved ones. If something were to happen to you, you now only control your debt going forward. And I can explain that too. So here's an example. Now, this is a federal employee example. This is somebody that we've talked to, we've assisted, and I just want to use it as an example. Okay. Yours could be slightly different. But when I talked to this particular federal employee, everything looked great on the front end. Everything looked awesome. And it was a solid conversation. We were going over all the benefits, the retirement calculations. We were looking at, all the money that they're saving. I said husband and wife were saving for retirement and made good money now, made really good money now, this federal employee, and was saving a whole bunch for their future. And in their retirement, looking at all the numbers on the front end, they were going to get really close to making the money that they were making pre-retirement in retirement. So there wasn't going to be much of a downside there. This was a great scenario. This is what everybody would want to see, that when you retire, you're going to be making just about the same amount of money in retirement that you're making that you're making before retirement. So let me say that one more time. Ideal scenario, you're making the same amount of money in retirement that you were making the day before you retired. Pretty awesome. Everything looked great. Then I asked about the debt. Hey, do me a favor though. This is great. Everything on the front end looks good. Let's talk about what's going out the door. Tell me about your debt. I had no idea what was going to happen. And this federal employee unloaded on me. Give me the laundry list of debt. We were adding it all up and looking at it. And this person had $652,000 worth of debt. Now you might say, Val, well, that's interesting because you said this person made great money. $650,000 could just be their mortgage. They can have a really, really nice house and they can have a $650,000 mortgage. That's true. I will say the mortgage was about $400,000. So that left about $250,000 of consumer debt that this person was trying to tackle right on top of the mortgage and making regular payments. And I'm talking some of these payments were even overpayments to try to pay this debt down sooner. But making all the regular payments that they were making, so the minimums plus the extras, they were going to be in debt for 20 years. And when I asked, I said, okay, what is your total debt that you owe? What is it? And like most people, they would say, well, they added up all the principal balances and it's over $652,000 that we owe. That's correct, but that's also incorrect at the same time. Currently, that's your principal balance, but over time, making regular payments over the next 20 years, you're going to pay over $400,000 more in interest, so totaling over $1 million that you're going to end up paying to get out of your $652,000 worth of debt in 20 years. So two things we want to do. We want to see if we can design a plan to not only cut into the amount of years you're in debt, get rid of your debt in a fraction of the time, but also reduce the volume of interest. Because what is interest? Interest is money, as you see in this illustration, money that you can simply just light on fire. You can throw in the trash, flush it down the toilet. It doesn't do you any good in this sense. Interest on the other side, being on the positive side of interest, yeah, you want to earn as much interest as possible in your TSP and other investments, things like that. But when interest is hurting you, when you're being charged interest on your payments, now it could be like running on a treadmill. Your interest on the front side is doing well, but the interest on the back side is pulling you back down. Hey, thanks for watching this clip of the Federal Retirement Show. If you like our content, click the button below so you can see more just like this.